But let's get straight to today's market action. Joining us now is Capital Area Planning Group Managing Partner Malcolm Ethridge and CNBC Senior Markets Commentator Mike Santoli. Great to have you both here on another update for the major averages. Malcolm, I will start with you. Trade talk, optimism abounds here. Is this what is driving the market? And if so, does this rebound have legs?
Yeah, so I think it shows just how much of an appetite there is out there for some sort of positive news on trade. Investors will take whatever we can get. This announcement obviously is not the biggie that we've all been waiting for. Everything revolves around China and when we will reach an accord with China. But I guess because it shows that other countries are willing to come to the table, they are willing to come to Pennsylvania Avenue to have this conference directly with this president, the market is seeing that as optimism. But I have a feeling it probably will fade with the next headline coming out of Beijing, letting us know that they aren't yet ready to talk.
Okay, we've got our first earnings report to bring you. Lyft results are out. Pippa Stevens has the numbers for us. Hi, Pippa.
Hey, Morgan, the stock jumping here. Q1 Lyft EPS coming in at 1 cent. We are not comparing that to estimates. Revenue, a slight miss here at $1.45 billion. Now, back in February, Lyft announced its inaugural buyback program of $500 million. Today, they said they are upsizing that to $750 million share repurchase program. That comes after activist investor Engine Capital called on the company to raise its buyback pace and also called on them to explore strategic alternatives, including a sale. Now, Lyft said this was the 16th consecutive quarter of double-digit year-on-year gross bookings growth, and also said that in the last week of March, rides reached the highest weekly levels in their history. You see there the stock up 5%. Morgan?
Okay, Pippa Stevens, thank you. Mike Santoli, your reaction to Lyft, especially after what we've heard from Uber and DoorDash and some of these other consumer-facing transportation names.
Yeah, it seems largely on target. I mean, I think the revenue is what you'd want to base that on, but the buyback is clearly getting traction in terms of the reflex trade right here. $750 million net buyback at this point. That's like 13-14% of the current market cap of Lyft. So that's a real big return of capital, a shrinking of the company's capital base because they're not really earning a proper return on it. So I would say that's, to me, the thing to extrapolate from here without looking at the insides of the bookings data and all the rest of it to get a read on Lyft's actual, position with consumers.
Okay. Malcolm, want to get your thoughts on what we have heard from earnings season so far, because so far it's been better than expected for the most part. We have seen some companies pull their guidance amid all this macroeconomic uncertainty, but we've also seen the companies that have either held steady with their guidance or in some cases, I think about Axon, who we're going to talk to later on in the show today, raising their guidance. Those companies have been rewarded. How does it position an investor for the rest of the year? Where would you be putting money to work?
Yeah, so we have two separate stories at work at the same time, right? We have the better than feared, I would even say, rather than expected, coming from Q1 earnings, where we were concerned that we were going to see significant slowdown. We were going to get negative guidance. We were going to get revisions and possibly earnings being pulled altogether, like you said. And we got a lot less of that than we expected. Tech especially coming in and saving the day with the hyperscalers, Meta increasing its CapEx plan in the face of everything that we know is coming for us as far as the tariff war and everything else is concerned. So investors should be as enthused as they are right now. But I think we also have to curb that enthusiasm a little bit heading into Q2 earnings reports, the quarter that we sit right now, because that's where we're more likely to see the damage that has been done by the tariffs that were put into place after Liberation Day, because obviously that was at the very beginning of April, which would start that quarter.
Well, Lyft investors are enthusiastic. Those shares are now up 11%, but Expedia shares are under pressure right now. Those earnings are out. Contessa Brewer has the numbers for us. Hi, Contessa.
Hi there, Morgan. Yeah, they're out with an earnings beat here, 40 cents per share adjusted against the street's expectations of 32 cents a share adjusted. Revenues coming in just shy of the street consensus. They were expecting $3.01 billion, and Expedia is reporting for the quarter $2.99 billion. Booked room nights come in just a little light at 107.7 million. The street was expecting 108.45 million. And the growth in booked room nights is much slower than expected at 6% versus the street's expectation of 10.7%. But look, in the group segments, you're looking at the B2C business, direct to consumers. That's pretty much in line. The B2B business, pretty much in line. But as you can see, the stock under pressure now, Morgan.
All right, shares down about 5%. Contessa Brewer, thank you. Mike, we've heard about a lot. We've seen a lot of softness, I should say, in some of the travel, leisure, and hospitality names. Not all of them. IHG, I think, case in point earlier today, but most of them. Expedia seems to be falling in line with that trend.
Yeah, for sure. I mean, that is really the key kind of vector along which, Expedia operates, and that's the measure of success is the room nights. Now, there's a case out there. Well, first of all, the stock's up 50% on a 12-month basis. It's been pretty strong. It's a very cheap stock. It's always been the value option within the booking companies, and I do think that anything that says we're losing momentum on room nights, even though Expedia has a reputation of sort of being counter-cyclical, in other words, they get more inventory when demand slows down, and it might be better for them. But at least initially, market's not really too pleased with that immediate trend.
Okay. Pinterest earnings are out as well. Julia Borston has those numbers. Hi, Julia.
Hey, Morgan. Pinterest revenues beating expectations, $855 million, ahead of estimates of $847 million. Earnings, though, falling short of expectations, 23 cents in adjusted earnings per share. That's short of the 26 cents that was estimated. The company did add 17 million monthly active users in the quarter. That's 5 million more than anticipated, to end with 570 million monthly active users. The company's second quarter revenue guidance is for a range of 960 to 980 million. The midpoint of that is ahead of the 966 million analyst consensus. The company is also giving EBITDA profit guidance in a slightly larger range than it gave last quarter, certainly reflecting some of that uncertainty many companies are seeing here, and they say they will be giving more guidance on the earnings call. Right after the call, we'll be talking to Pinterest CEO Bill Ready in a first on CNBC interview that's coming up on Closing Bell Overtime. Back over to you.
All right. Julia Borston, thank you. We've got Affirm earnings out, too. Mackenzie Segalos has those numbers. Hi, Mackenzie.
Hey, Morgan. So Affirm shares down about 6.5% in extended trading, despite reporting a surprise profit of 1 cent per share and beating estimates for a 3-cent loss. Revenue was in line at $783 million, up 36% from the year-ago quarter. Now, gross merchandise volume, a key metric looking at the total value of transactions, hit $8.6 billion, also topping forecasts. One standout number here, 0% monthly installment loans grew 44%, a strong sign because these are merchant subsidized and attract higher quality borrowers. Credit quality, that held steady with pay in 4 losses below 1%. The company, though, issuing a weaker than expected forecast for the current quarter. It's guiding fourth quarter revenue in the range of $815 to $845 million, which is just below that average estimate of $841 million. Those shares down more than 10% now. Morgan?
All right, Mackenzie, thank you. Malcolm, want to get your reaction to this, since I know you were watching this name in particular here after the bell.
Yeah, so Affirm is interesting to me because it can be seen as a bit of a canary in the coal mine, considering we have expectations that consumer spending is going to slow down, especially in the traditional ways. So maybe Visa, for example, MasterCard, we see transaction volume stay there, but a secondary lender such as Affirm, you'd expect to pick up at a time when consumers are looking for ways to stretch out those payments. So I'm interested in digging into the guidance to understand why they see fourth quarter profits dipping a little bit rather than increasing. I think that's going to be a little bit telling as we try and figure out where we're heading as far as the consumer is concerned in the second half of this year.
Mike, I mean, I'm looking at the chart here on the screen. I mean, Affirm is down 10%. It sort of goes back to where we started this conversation just a few moments ago, and that is if you're putting a guide out that's not in line or better than expected, you're getting hit pretty hard by investors in this environment, maybe perhaps speaking to how skittish investors are in this environment.
Right, and absolutely a very volatile stock in itself as well. I mean, we can keep in mind that Affirm at one point was like a $160 stock, and because it's kind of, fast growing and not really earning a ton in the moment, it just sort of whips around when there's any slight change. So I think the revenue implicit guide down, or at least the guide in the range below the current forecast, does indicate that maybe April, some consumer companies have been saying April was a little bit of a hesitation month. So not terrible. A lot of things feed into Affirm. It's kind of how they finance their own loans. So the capital markets have to be receptive. If we get some rate cuts down the road, probably would help sentiment toward the stock. But right now, it just looks like a bit of a stutter step fundamentally.
Malcolm, Tech X Mag 7, is that compelling here, or do you really want to stick with the bigger names because they're more defensive?
Yeah, so I'm actually going to make a separation between enterprise tech and consumer-facing tech, right? So Apple, for example, relies on the consumer quite a bit. You could say Meta, maybe Alphabet also rely on the consumer because everything there is ad-supported. But if we look at like a Microsoft, for example, and NVIDIA, IBM as another example, those are companies that sell directly to enterprises where it takes a lot longer for slowdowns in spending to actually hit them. And so I think if I really want to be invested in tech, but I don't necessarily want to have to own the entire Mag 7, which is going to be relying on potentially a slowing down consumer, then I definitely want to be looking at enterprise as the way to go.
Mike, we saw the first trade deal framework, I'll call it, announced today between the U.S. and the U.K. We know there's an envoy headed to Switzerland to begin talks with China here, too. We're just a little over 24 hours out after Fed Chair Powell's press conference, where he basically used the word wait or a word similar to wait, I think something like 22 times, according to one report I saw. If you see more of these trade deals start to happen, or you don't see that meaningful bump in inflation because maybe the tariff timelines in the midst of some of these deal frameworks gets pushed out, what does that mean in terms of the Fed's ability to be more flexible?
Well, I think it'll enhance their ability to do so, but I still think they're in a mode where they're going to need to see something solid in terms of across-the-board policy, and they're going to need a couple of months of data to show them one way or the other whether they should be more attentive to growth risks or inflation risks. I think the market feels that way. The market's basically feeling by July they may have what they need to perhaps do another rate cut, but it is pretty contingent at this point. Also, in the market reaction today, for as much as the market celebrated this incremental progress on the UK trade deal, we did finish in the S&P 1% off the highs. There was a bit of a fade. It shows you the higher the market goes, the higher the threshold goes for what can please investors that qualifies as trade progress.
Okay. Gentlemen, thanks for kicking off the hour with me. Malcolm Ethridge. Thank you. Mike, we'll see you in a little bit. With all the major averages finishing the day higher, the Russell 2000, those small caps, the biggest winner, up 2.2%. After the break, the man who was at the president's side today.